My name is Lisa Hanselman. I have been working with New Jersey Inheritance and Estate Tax for almost 12 years. I wanted to just let you know a little bit about myself. So during COVID time, I worked on our non-audit amended returns. I started working with Tax University, which is also our team unit, the education outreach program, about 3 years ago when they put out a request to have some people in the different units of taxation to come out and help them go out and talk to the tax professionals. And during that point, I came up with the idea that I thought it was really important to also talk to the public about inheritance tax. I think it's really important that people know about this tax because it's almost too late to learn about it right when you're going through it. So just to give you just a little bit of understanding that we even exist is really my main purpose for today. So just so that you know, you can ask questions, so please put them in the chat. We'll stop periodically for you to answer. Today is just more for general questions. If you have more specific questions, I'll ask that you just reach out to our helpline. We also have information online that you'll be able to access at a later date. So how do I start the getting it up? Okay, hold on just one moment. Sorry about that. Okay, so here we go. So the first thing that I want to just do is just give you a rundown of what we're going to be going over today. So this is just a little bit of information. These are the topics that we're going to be discussing. What is inheritance and estate tax? What the role of an executor or an administrator would be, the types of the beneficiary classes, the filing of the returns, and how to obtain a waiver. And the waiver is a word that I'm going to be using over and over again today. Important things that I think you should know, and resources for you to help you along. So again, first we're starting with what is inheritance and estate tax. So I'm going to let you know that is really important because when I first started working here, I had never even heard of inheritance and estate tax. And so when I actually started the first day, I had no idea. All I knew was that I was working for taxation and that I was in our I tab, which was inheritance income tax. And so I had no idea where I was going. I was brought up to a little room and we had this gentleman stand up and he said he's going to specifically call out 7 people's names. And I sat there saying, oh, please, please, please don't call me. And sure enough, he did. And that was my introduction to inheritance tax. Little did I know that 12 years later, I'd be giving seminars on it. So first, we're going to start with it. And so what is inheritance and estate tax? So basically, it is a transfer tax. So what happens is that property is in essence, it is transferred from the person who passes away to a person who is going to receive it. The person who passes away, we refer to them as the decedent. The person who is going to receive it is the beneficiary. The tax is then based on the person who is going to receive the asset and how much they're receiving or the size of the estate. The key that you have to know in this situation is that it is all based on where the person who passed away, again, the decedent, where they lived, where they were domiciled at their date of death. So a little information about New Jersey inheritance tax. It was a tax that was established Sorry for the interruption. We had an announcement in the office. Um, so it is important to know again that it is based on the relationship that the beneficiary has to the decedent. It's very important that you do understand that. And then a little information about the estate tax, which we will not be focusing on, but I still wanted to give you a little bit of a background on it. It was enacted in 1934. It was based on the size of the entire estate, not your relationship to the decedent. The estate tax is no longer imposed as of January 1st, 2018. When we were using it, what happened was there would be times when an estate was over $675,000. We wanted to make sure that we were taking care of those larger estates, and they were for people when the estates had only Class A beneficiaries, which were part of an inheritance tax. And so people who are Class A's are not taxed, and I will discuss that a little later. I'll explain that to you. And it was a way to capture some money for them. Just so that you know, you were never double taxed. We would only take the larger of the two. But it was taxed until 2017. It was if the estate was greater than $675,000. It then went up to $2 million, and then it was sunsetted as of 2018. It is still on the books, but as of right now, there are no plans to bring it back. So now, Soli, have there been any questions so far?
Not so far.
Okay, great. Then I will continue. So what I will continue with is the role of an executor or an administrator. So the executor or the administrator, this would be the person who is going to be in charge of everything relating to the estate. Keep in mind that when, as an auditor, when I am referring to an estate, I am just referring to anything that is owned by the decedent. From our perspective, it doesn't matter how large or how small the person's assets were. A person can only own $1,000 worth of something. We still refer to that as an estate. So this is the person who is responsible for filing a return. They're responsible for gathering all of that information that is necessary in order to get all of the work done. This person is also responsible for being a liaison between the branch, the estate, the financial institutions, the beneficiaries, which is really important because what we do is we really like to only speak to one person because it is a very, very busy office and we can't speak to so many different people. So we choose just to speak to the executor or the administrator or the person who is their representative. We can't just speak to every single person. It gets too complicated. So it streamlines the situation for us. They are also the people who will obtain and then distribute the waivers. Again, there's that word, please keep it in mind. So understand it is a very important role to have. So if you choose to take on that role when you're speaking to people, or if you choose to, if you're thinking about who will be an executor for your estate, please choose that person carefully and wisely because it is a big responsibility. Okay, so we're now going to just be talking about the return. And again, please make sure that you understand that for this presentation, I am basically speaking about only the inheritance tax return. Who is going to be able to file a return? The executor, number one. This is the person who is named in the will by the decedent, and they are then appointed by the surrogate's office. There's also the administrator who would be appointed by the surrogate whenever there is not a will. Sometimes there are also situations that occur and legal actions are taken, and then there's a person who is also a person, excuse me, who is also appointed, and they could also be an administrator as well. An heir at law. That is any person who is legally entitled to inherit some or all of the decedent's estate. Sometimes that person might have no idea who the executor is or who the administrator is. They just have one asset. They know that they are responsible, that they are either the beneficiary, they're named on an account, and so they just want to receive that money. They want to receive something, so they'll send in a return for us. Sometimes they just might have no idea that a return has already been filed. There have been instances where, as a result of getting a return from an heir at law, we even find out about an estate, and we are then able to contact somebody. They will know who an executor is, and we're able to then go find out and contact them. From all of these people, we also can have their personal representative fill out a return for us. When I say a personal representative, usually that means an attorney who is a member of the New Jersey bar. We want somebody from the New Jersey bar because that will enable you to then use their fees and to be able to put that in as a deduction for you. If the person is not a member of the New Jersey bar, you may not deduct their fees on the return. You can have a CPA, you can have a person who is an EA, which is also, they are called an enrolled agent. So just so that you know, all of those people may also fill out the return, and they will then be your contact for you. Just going to turn the page. Okay. So now, just to give you a little bit of an information page about what information that you need financially in order to get a return and make it as complete as possible. So you want to make sure that what you're doing is accounting for all of the decedent's assets. So you want to have all bank accounts and brokerage accounts, all mutual funds, anything that is an asset. You can have stocks and bonds, whether they are from New Jersey or not, life insurance. I've had questions before where people say, do I need life insurance to be included? Yes, life insurance should be shown. It is includable in the estate for our purposes if the beneficiary is the estate. If it's a straight life insurance policy where the beneficiary is a named beneficiary, you do not need to include it on the return. It will not be taxable. Excuse me. Make sure you have real estate information, which includes the deed. It could include the mortgage information as well. Please also make sure that you have personal property, and that could include boats, that could include artwork, that could include automobiles and jewelry. That can add up in value. If it's just something minor value, you don't have to necessarily, something that's just a little ring like that, but we're talking items of value. Assets that are transferred before death within 3 years. We're talking about gifts. We're talking about when people sometimes try to transfer their houses within 3 years and say that they're gifting over their homes or they're gifting over a significant amount of money within 3 years. We do need to look at that. It is separate from an income tax situation. We do need to look at it because there is a possibility that that could be includable and that could be taxed. Next, you want to make sure that you're going to gather all of your debts and bills. You want to make sure that your liabilities as of the decedent's date of death are all includable in there with you. So the way that I like to explain it is that if somebody passes away, you're going to take a snapshot of them as of their date of death. So the way I say it is that today is August 3rd, and I passed away. We'll make it easy, make it myself. So today I pass away. I own a house, I own a car, I own some stocks, I own mutual funds. What is it worth today? I don't care what it's worth in 5 weeks. I don't care what it was worth a month ago. I need to know today. So generally, that's what we're interested in because that's what this tax is. It's a date of death tax. There are some exceptions, and I'll explain that in a minute. So we're going to have what it's worth. We want to know also debts that are due as of that date. What's my mortgage as of today? What bills did I have that are outstanding as of today? Plus, we're also going to include anything related to the death expenses, the funeral, any kind of cost that went around with maybe hospitalization for me, attorney fees that had to go, executor and admin commissions that went. So then what you're going to do is you're going to take, for those of you who are accountants, I always keep it and I say that, first thing you learn when you take accounting classes, assets minus liabilities, that equals equity. So that's basically how we look at it. So just going back to explaining date of death, of course, sometimes there is something that will be unforeseen. The most obvious example, we are now living in a pretty much a post-COVID world right now. So using that as our example, when we talk about the pricing of a home, we generally look at the cost, what it's worth of a home in general, what the market will bear. So if a home is said to be valued at a certain price and it sells in general within a few months, we are going to go at that date, what it's sold for, because usually in general, the market doesn't shift that much. However, with COVID, we have seen prices skyrocket. So my example would be in March of 2021, somebody passes away. We've noticed that especially as of, let's say, July of 2021, the market just went up way high. So if a house, I'm just going to make up a number, if a house was worth in March of 2021, $300,000, but then with all of the craziness that went on with all of the bidding in July of 2021 sold for 400,000, we may take a look at that, be reasonable, even though we're looking at a HUD statement, at a closing disclosure, we may still, if the estate comes and says, but really on March 2021, it was worth $300,000, we will take a look at that and we will decide. And it is possible that we could still, under the circumstances, look at that house and say, you know what, you're right. They passed away before the housing market exploded, and we will take that into consideration. So understand, we are very reasonable when it comes to information like that. Okay. So
We do have
before
some questions.
okay, great. I was just going to say before I move on. Okay, Soli.
Perfect, Lisa. Okay, so it was referring to, I think, slide 10, but it says, how about joint bank accounts with the decedent and the beneficiary?
What's the question?
Would they, I think it was from slide 10. I don't have
Okay, so
presentation.
okay, so let me see what that is here. I could actually go. Here, let me look at it. So do we need it? I guess. So if the question is, do we need to put that in? Yes, you still need to put that in. Yes, a waiver is still needed for that. What happens in that situation is that the people need to show proof of contribution. They need to show if they had put money in there. A lot of times people are joint purely by name only. So sometimes they could put it in at 100% still. It just means that we know that the asset will be going to that person. Other times it could be that if they both contributed to it, that they will only have to report it at a percentage of contribution. So I'm not sure if that answers the question. If there's more to it, they could let us know. But hopefully that answers the question.
Okay. The next question was in terms of like, can a person decline the role of executor?
I believe so. I think that would have something to do more with the family and with the surrogate's office, but I don't see why not.
Thanks, Lisa. And the last question with regards to this previous section is, what about a home sold in New York that is split between 3 beneficiaries? How is that treated?
Okay, this is only based on, in inheritance tax, we only deal with homes and real estate and items that are in New Jersey. So a New York property would not have to be listed on the return. However, that also means expenses relating to that home would not be includable on the return either.
Okay, I think that answers that question. And then
Great.
in terms of that, another question was asked, no
Sure.
inheritance tax. Correct. Was this the same person? Let me just make sure. If the value of the home is similar to how the Fed taxes include significant home improvements, less value.
So a lot of times when the house is sold, if the price was increased because of information that was because of work that was done on the home, they can sometimes deduct some of those costs. That's a specific situation. We would have to take a look at it to see what's going on. So we do look at everything case by case. So in that specific situation, I would have to look at it and see, or a different auditor might have to look at it and see how it works out. But we do look at when, like I said, if it seems like it's really high and it was brought up because of that, potentially we would look at it. But it could be that we would also take the deductions. That's what I believe they're asking.
So on a case by case basis,
Yes.
essentially. Okay. Perfect.
Essentially, yes. Better way to say it.
The next question is, can the surviving joint bank account owner file their own inheritance tax return if they are other than a Class A beneficiary?
So it's kind of hard to answer that question. Technically, yes, we don't prefer it. We prefer people to have it all together. The main answer is we prefer to have it done by the executor and by the administrator. We don't want to have a million returns coming in. So our main goal is to have it all in by the one person. If that person knows who the executor is, they should contact the executor and they should include it on that return. That's the correct way to do it. If the executor knows that that account exists, they will include it on there. That's my best answer.
Thank you, Lisa.
You're
and then
welcome.
One of the last questions here, I don't see anything else coming through, but one of the last questions for this section again is, do bank accounts established in New York need to be included and/or a waiver completed?
So all bank accounts should be included, but as long as there's a branch in New Jersey, they would need a waiver. If there's not a branch in New Jersey, they wouldn't need a waiver, but they would still be includable as far as an asset.
Okay. And what's the time limit to file the tax return?
I will be talking about that in a little bit.
Perfect.
Stay tuned.
Thank you, Lisa.
Thank you. Okay. So here we go now. We're going to start talking about the type of beneficiary classes. So once we start with the returns, now we know a little bit more about the returns. And so I have it broken down. Oops, I went too far. Forgive me. Shaky hands. Okay. So we currently have 4 classes of beneficiaries, and it's broken down into your non-taxable and your taxable. And if you look, you see A, C, D, and E. There is no B. B once existed, and it hasn't been around since before I was born. It's been gone a long, long time, that means. So the first ones, A and E, for the most part, generally speaking, are non-taxable. There might be certain situations where they could be, but we're going to go with that they're non-taxable. Then the 2 that are taxable are classes C and D. So I'm going to describe and explain to you what the 2 classes that are non-taxable are, and then I'll go into, the non-taxable, and then I'll go into what the taxable classes are. Again, please understand this is only for inheritance tax purposes. It is generally speaking, and it is that there could potentially be a tax, but we're going with it in general. So, Class A, exempt from inheritance tax. This includes the following: surviving spouses, civil union partners and domestic partners, lineal relatives. So it's going up and down your family line. Children, grandparents, grandchildren, anyone who is down that bloodline. Other Class A would be stepchildren. And then we also have mutually acknowledged children. This is a special class for people. It would have to be approved by the division. I give the example, I remember pretty much when I first started, I had this one example of a person who had been living with a person who may have been their aunt or uncle. They had been living with them since early childhood. They stayed with them about until well after the age of majority. And this person raised them as if this gentleman was their child. And they were able to supply me with the evidence. They had report cards that were signed by them. They had income tax returns that included the child. And so we asked them a series of questions, and they were able to provide me with all of the evidence and more. They had written proof from relatives who said that they lived with them and were taking care of them. So even though technically they were a different class, which I'll get into, a Class D beneficiary, for our purposes and for theirs, they were raised like a child, and we were really happy. It was my pleasure to say, yes, you are a Class A beneficiary. You are tax exempt. And I was very happy they didn't have to pay. So understanding now, looking at these lines, I want to point out a few of the following. One thing is that the state of New Jersey does not recognize common law marriage. So you cannot be living with somebody and just say that you were married. It is not a legal term. Common law is not legal. If you say that you were common law, you're a Class D, unfortunately. So there might be times that because of new things that have come into law for us, we may have to ask for proof. There is a certificate of domestic partnership. So if somebody had said that they were domestic partners from way back before we had same-sex marriage, we may ask for that certificate. I'm pretty sure it still holds. The lineal relatives, like I said, goes up and down the line. Class A with the stepchildren, please understand the following. It is only stepchildren. Notice, does not include step-grandchildren. It does not include step-parents. By the same token, it doesn't matter at what age you become a stepchild. So what that means, if my parents were divorced and were to get remarried, at my age, being an adult, way older than 30, I would still be considered a stepchild. I would still be a Class A beneficiary. So keep that in mind, and also keep in mind it only goes down to the stepchild, it wouldn't include my children. Okay, our next exempt category, Class E, it's basically all of your charitable groups. The exempt organizations would be educational, religious, hospital medical researches, public libraries, 501c3 charitable organizations, state of New Jersey, counties, local, anything, because like I like to say, who wouldn't want to give to the state of New Jersey? It's important to give as much information as you can. We can look up the information, but if you have it and you have the proof that the charity is a 501c, just send it along. It helps us so that we could see it. We don't have to look it up. There might be other organizations as well that we're not aware of or that just didn't hit our radar. So if you think it could be a charity and you're not sure, just send us the information. We'll look it up. I did have I'm sorry, excuse me. I did have an instance where I had a museum that was in Maryland that was not 501c3 several years ago. We looked into it. It was evident that it was a not-for-profit. And we did some research, and my supervisor and I came to the conclusion that even though it was not listed as a 501c3, it was eligible to be considered not-for-profit and charitable, and therefore we accepted it as a charitable organization, and it was indeed exempt. So sometimes it could be, it's another situation of where it is a case-by-case situation. Okay. So these are the two categories of where we have tax exempt. Now I'm going to go into the categories that are taxable. So the first would be Class C. And basically the two areas are siblings and spouses of children. So siblings, this includes half siblings. As long as you share one parent, you are considered a sibling. It's not a stepchild, it's a sibling. So people ask sometimes, what about adopted children? If you're adopted, you're a child, you're a full child. So that counts. Spouse, civil union partner of decedent's child. Basically, your son-in-law, your daughter-in-law in any way or shape. So those are the people who are Class Cs. And so now I'm going to just explain quickly about the tax rate that we have. The key here to understand is that it is per individual. So if you look at this, the Class C beneficiary, you are exempt. Each individual, I should say, is exempt for the first $25,000. So a lot of times you'll see on a return that people will leave to their siblings, leave each of them $25,000. So what that means is they're not taxed. They have no tax. But then anything above and beyond that will be taxed on a scale ranging from 11% to 16%. Inheritance tax does not go above 16%. So, and it's only that amount that goes above the next category. So if you look, the first one you see, it says over 25,000 to 1.1 million. So that amount is taxed at 11%. That's where majority of the people fall if they're going to have any tax whatsoever. But then if there's an amount that's up to 1.4 million, only that amount between 1.1 and 1.4 is taxed at 13%. The amount that was up to the 1.1 will be taxed at 11%. So there would be two different tax rates that are going. And if you just take a look briefly, I'll let you just take a look at it so you can see what it is. I was going to try to make a slide to explain just a simple tax rate. We didn't get a chance to put it in, so I'm going to just explain it to you so that it just registers that it is per individual. If you have an estate that is $100,000 and you have two siblings, and that's where your entire estate is going. So that means that each sibling is getting half of that estate. So each sibling is now getting $50,000. So for each sibling, they are exempt for the first 25, thank you, the first $25,000. So that's for each of them. So from there, the net estate that each of them will be taxed is $25,000. So looking on the on that schedule there, because it's over $25,000. So the $25,000 that is taxable at 11%. So that means that each of them will be taxed $2,750 for a total tax of $5,500. So on an estate of $100,000 going to two Class C beneficiaries, the estate is taxed $5,500. And that's not that bad considering that you have to pay any tax at all. And again, it's because each of them are getting the $25,000 exemption. Okay, so now we're going to go to the Class D beneficiaries. Basically, this covers everyone else who has not been accounted for as of yet. So it's going to be any of your distant relatives, aunts, uncles, nieces, nephews, cousins, your ex-spouse. Once you're divorced, you are no longer a Class A, you are a Class D. Even if you have a great relationship with them, you're a Class D. Step-grandchildren, remember I said that before, step-grandchildren, people who are fiancés. Unfortunately, like I said, if you're living with someone but you're not married, even if you are a fiancé, you are still going to be a Class D. Again, another situation when I first started and for a few years, our auditors, had to answer phone calls on our hotline. One of the beauties of our department is that we take care of everything in inheritance tax. When you call our hotline, it's specifically for inheritance tax. Excuse me. And I will never forget speaking to a woman who had called and the gentleman in her life had passed away. And when I asked her what her relationship was to the gentleman who died, she said, the fiance. And I informed her that, you know, she's still a Class D because she wasn't married. So basically she could have been anyone. So the tax rates for these people, for everybody, are either 15% or 16%. And again, it is per individual. So the first 700,000 is at 15%. Anything over that is at 16%. And again, I will say, and I think my fellow auditors will back me up, I cannot tell you how many times I will see a return where the estate is $1 million, all Class D beneficiaries, at least 3 beneficiaries, and they put in the tax rate at the first 700,000 at 15%, which is $105,000. The next 300,000 at 16%, because they're just thinking in their heads that anything over $700,000 is taxed at 16%. But now that you're here, you know that it's per individual. So since if it's all getting split up between a lot of people and you have only $1 million, clearly no one is getting at least 700,000. So the entire estate should be taxed at 15%. Okay. So now we're going to go to filing tax returns and obtaining waivers. Soli, were there any more questions? I lost Soli.
No, we're all caught up.
Okay, great. Thank you, Mike. Okay. So I'm going to talk a little bit just about filing the tax returns and how you're going to obtain waivers, which is still that magic word. So basically, we understand it's a really sad tax if you think about it. It's an upsetting time for everybody. People really want to move on with their life. We get it. Nobody wants to be taxed. It's a different essence when you're in our office. It's a different feeling. Understand that a major difference between filing an inheritance tax and filing an income tax return, it's not done every year. It's something people aren't familiar with. And it's also, it's not like you sit there and you send it in hoping that you don't get audited. With us, we look at every single return, and I would say at least half of them get selected for audit because people aren't familiar with doing them. So people, being that they're not familiar with them, there might be something missing. It could be something very little, but they really do get looked at, and chances are it's going to get selected for audit. So just understand that.
Lisa, can I
So
interrupt for 1 second?
sure thing.
There was a question.
Okay.
International charitable organization is considered inheritance tax exemption?
I would have to look at it and see. It's potentially that it would still be okay, but we would have to see.
Okay, thank you.
You're welcome. So the purpose of an inheritance tax return, it's got a few purposes. We want to make sure that all the assets that are owned by the decedent, that it would be accounted for as of the date of death. And this is to help you to put everything in order. You want to confirm that the inheritance tax is carefully assessed and that the liability is paid on time and correctly. You also are going to want to obtain waivers, and you want to know, what is a waiver? The waiver, our legal definition, our official definition is it's the written consent of the director of the Division of Taxation to transfer or release certain property in the name of a decedent. What does that mean? I will continue and let you know. Think about it though. Okay. So my tip though first is that what you want to do is pay as fast as you can. And if you question something, you could still pay for it now and question it after, because we do give refunds. We do work with you. And so if you have a question, a lot of times when an assessment comes in, you have 90 days to question everything, but get it in before interest starts accruing. It's in your best benefit, in your best interest to do that. So, filing inheritance tax resident return. So, for the most part, it is required for classes C, D, and E. Here, when somebody asks what the due date is, we are not on a year-end basis. I think I said that before. Every return is an individual, has an individual date that it is due. That is 8 months from the date of death. If it is an estate tax, which like I said, we're not dealing with, but I still put it up there, that's 9 months. For the most part, there's not a penalty for being late other than that interest might be due if there is tax that is owed. So interest is owed at 10% per year and it's accrued. So it would be a portion of that would be owed if you're late. That's if it's late. So you may pay online, however, you must file by paper. So that is because we don't have, our system is not equipped to handle it. Every return is so individualized. We have some returns that could be this thick. We have returns that could be this big. We have returns that come in boxes because they are that large. So in general, you do the best that you can. And if you have other questions about it, you can call our hotline and I'll give you the number later. Like I said, everybody has a unique date. People have asked me, when is our busy season? We don't have a busy season because of this happening, that it is by date. And as I explained before, due to the complexity of the tax, every return is screened. It goes through a process. And so while you're doing anything, you know that you can always call and ask us for questions if you have questions. Oh, here we go. Here comes the big thing. I like to refer to it as the golden ticket because it means you're done and it means we do cartwheels and everybody gets all excited, and for your estate, everybody's thrilled. This is the waivers. So the purpose of obtaining a waiver is so that you could show everyone that you're finished with the state and you don't have to talk to us anymore. Haha. No, but really it's so that you can be finished and so that you could get done with the business of carrying on with your estate. You can now transfer your real estate. You can now close all your New Jersey accounts. You can now sell or transfer your New Jersey stocks that you have. That means that they are registered in New Jersey. You could transfer your IRAs that are held in New Jersey and municipal bonds that are New Jersey municipal bonds. So, how do you get these waivers? If you are class E, C, or D, what you have to do is file an inheritance tax return or an estate tax return, because you can't get a waiver until you pay all your taxes. So what happens is a review will be done. We will look at everything. We're going to make sure that all the taxes are paid. We will issue your waiver on all of the qualified assets that are reported on the return. And don't worry, you don't have to tell us to do it. We know. We are really aware that this is what has to be done. We have a process and it will go on and do it. It will go on to the next step and our waiver department will issue the waivers for you. We have another little thing for people, which is an L4. An L4 now has more than one role. Its major role originally was for people to have a partial release of waivers. It's done on a case-by-case situation. It's when people need just a few of their assets released and they know that they're not done. They know that the return really needs to still be completed, but they need just a few things. So they will fill out this form. We have someone review it. You might put in that you need 7 assets waivers for them, and somebody who will review it, and they may say, well, maybe only 3. We may only allow 3, but this is the way that it can get done, and that will speed up part of it for you. L4s are also now used for trusts. If you have questions about that at a later date, you can call our office about that. But that's when you have only Class A beneficiaries. You know there's no way you will have a tax owed. And so you can fill out an L4 for that as well. Again, just keep in mind, it's not a guarantee that you will get some waivers early, but it can help you and put you in the right direction for it. You just have to meet specific criteria for that. Okay, so people who are Class A exempt, they don't have to fill out an entire inheritance tax return. We have some shortcuts for them. One of them is that they can file an L9. This is for real property only, and real property is the real estate. They would have to fill out the form, which you can get from us online, fill it out, submit it to our office. We have people who look at that, make sure everything is correct, and then they will issue you a waiver. Then we also have what's called an L8, which is known as a self-executing waiver. This is for financial accounts, whether it be stocks that are traded in New Jersey, or for specific IRAs, it is for bank accounts. You submit them solely to the financial institution. Do not send them to us. We don't do anything with them. They are only for Class A beneficiaries. If there is someone who is a different class who is receiving them, you cannot use an L8 form. Then, as I explained before, the L4 you can use as well. Okay. So just briefly, I'm not really going to go into this. I'm just letting you know that we also do have, it's not working. We do also have non-resident returns. They're only for inheritance tax purposes. You would fill out a form L9 and R. Excuse me, I need to take a drink. That's where you would still have some property in New Jersey, but you live elsewhere. Have a little flow chart that is also on our website. If you have any sort of questions regarding regarding non-residents, you can call our hotline and speak to someone. It's really specific. So if you are concerned that you might have a non-resident situation, just take a look online or call our hotline, and someone should be able to help you there. Okay, so now I'm going to move on into important things to know if you're going to be in charge of a return, in charge of an estate. Information that I've spoken with other auditors and with our chief, and who we decided that this might be good for you. But first, I just want to make sure, were there any other questions right now regarding the waivers?
No other questions right now.
Okay. No, she said, right? Okay, thanks, Talisha. Okay. So this, again, like I said, I thought it was really good to know. If you're going to be in charge of an estate, or if it's for yourself and you want to make sure that everything is organized, it would be good to know the following. These are good tips. So know the location of the last will and testament and the trust that you may or may not have. Figure out who's going to be the executor. Think about somebody who would be responsible. Make sure they know as well. It would be good if the person's not surprised. A really good tip to know is that if you're going to have prepayment of funeral expenses, one thing that you can do is have it set up with life insurance and have the funeral home listed as the named beneficiary. This way the money will go directly to them and there won't be a delay in payment for them. Another thing that you could do is have a bank account set up in their name and then have it in trust for your name. This way also you don't have to deal with a waiver in that regard, and they can get the money right away, and that helps just alleviate a lot of problems because sometimes people can't get the money released, and that's really, really hard. And it just alleviates a lot of red tape for you and a lot of stress. You also might want to have somewhere a list of all of your assets, and with all of this information that I have. Bank accounts, passwords, that's a really good one to have so that somebody knows what your passwords are. Deeds for real property, because like I said before, we need to look at the deeds because sometimes the deed, the way it's written, can help guide us as to the way something is supposed to be taxed and who it's supposed to go to. It does make a difference. brokerage accounts, life insurance and annuities. And then you also might want to know about your monthly bills, your account names, also your bank accounts, your passwords, your payment amounts, the method, how it's paid for, because you need to know that if these are recurring bills, you might want to stop them. I just had somebody who they had, it was a small account, but it had maybe $3,000 in it. And it was getting charged monthly, paying for things after the woman's sister passed away. She didn't know how to stop it. And so she lost all that money in that account. I felt really bad for her, but there was nothing that I could do. Mortgages and leases, car payments, insurance payments, you want to stop all of that. You want to make sure. If there are monthly charitable payments, you want to know if the person has an arrangement to pay for something over 10 years versus just one payment. A lot of times people, what they try to do is just, they'll have money and they'll say out of the kindness of their heart, they want to just make a charitable payment. And then they'll put it down in an expense. And that's not an allowable expense. You can make a charitable payment on behalf of the person who passed away, but that's your decision to do that, not allowable expense. However, if there's a person, if the decedent was making something, let's say for 10 years, they were making payments and they had an agreement and they only had done that agreement for 3 of those years, well, they still have 7 more years to pay on it. So therefore, that would be an allowable expense. So that's just an example. There might be other expenses that you have. Also your date of death expenses, like I said, anything hospital related, any unpaid bills as of death, just keep that. It's really important to try to keep organized as possible. I know for myself, I'm kind of a slob, so sometimes I think about that it would be really good to have that in order, more in order for my children. Okay. Tips for you just to keep in mind. Please understand it does take time, this process. Processing time will vary. You know, we are coming out of COVID. It took us a long time. We took a big hit like everybody else did with people not coming into work. We weren't allowed to come into work. Then we had some people who were able to work from home, some people who couldn't work from home. We're pretty much up to full speed, but you know, people are still getting sick and everything else. So it does take time. And so it's not just going to be like this. Also understand the state of New Jersey is the most densely populated state. We are a very busy office. So there's a lot of activity. If you send in something in 3 weeks, well, there are many different areas where everything has to reach before it even hits our desks. So things, you may have sent it in, your check might have even cleared the bank. It doesn't mean that it even hit our computer system, let alone an auditor's desk. So understand it is a process. It takes a long time. Also a big thing to understand that waivers cannot be downloaded. They are manually input. Each one is manually inputted. We have people dedicated to doing that. So it does take time to do that. Patience is so important, and we are here to help all the time. We have our own personal hotline, and if you are selected for audit, you can deal directly with your auditor. We are approachable. We want to help you. If we ask for something, your best bet is to get it in as soon as possible, because the quicker you get it in, the quicker we could turn it around. And like I always say, we want to help you. We try to be as nice as possible. We want to be efficient and get it done. So with that, we have some resources for assistance. Oh, but before we go, are there any questions right now?
Yes, thanks for
Okay.
asking, Lisa. Okay, we do have a question here. How is an executor typically compensated for their services?
So we do have a system. It is part of our code. You could look that up online. It has to do with gross assets. So in general, it's 5% of the first $200,000, then 3.5% of the next 800,000, and then 2% after that. However, there are certain caveats to that. Real property is only allowed to be included if it's sold. Anything that is a joint account is not includable. And then if there are named beneficiaries on bank accounts, that is not includable as well, along with other things. So you can look that up on our website to see that, but that's the general guideline for it.
Thanks, Lisa. There's another question here.
Sure.
If the charity was named in the will, would the charitable contribution be an allowable expense? Or would
wouldn't
that
be-
possibly?
Yeah, that wouldn't be considered an expense. I see that Mike Rosen answered that. He's our chief.
Okay.
I just saw that he
Perfect.
answered it. So
Mhm.
it's not an expense. That would be, the charity would be considered a beneficiary in that situation. And so that would go under as a Class E beneficiary.
Okay, perfect. Just wanted to put it out there just in case someone
Yes,
had missed it.
absolutely.
All right. And then someone just had a great comment here. Having income taxes returns handy are also good summary document for the executor dash administrator.
100%. Yes,
that's
because we do
very
ask
true.
for that. That's one of the requirements. I think I forgot to put that in there. Thank you. Something to
Sure.
add.
Absolutely. Someone commented on the fact that there's some excellent information, particularly in the important things to know section of
Thank
the
you.
presentation.
Great.
So all this information, will be, not necessarily the actual PowerPoint, but information on inheritance tax is available on our website, as you mentioned, Lisa, correct?
Yes. A lot of it is located on there, and anybody can call our hotline. Like I said, we have very dedicated people. They're really, really knowledgeable. They're good specifically to inheritance tax because we have our own hotline. If you look right now, I just put it up by phone, that number. You can call them, you can ask them anything you want. If they don't know the answers, they will forward it to somebody who does. You can also look on the website to ask and to find information, and it's all there.
Perfect.
Oh,
There
yes,
is
and we also
another
have, yes.
question. Yes. Can you collect an executor's fee and attorney's fee together?
Mike Rosen. You can. I want to see what Mike was going to say. Mike, you still there?
Yes, let me just answer that formally. If the attorney is an executor also, they can have separate fees. They can be an executor and collect the appropriate executor commission and also their attorney fee. So if that's the only, that's a situation where that would happen. I'm not sure what you're asking exactly, but yes, that can be done, and you can pay an attorney, and the executor, being someone else, can collect their fees because that is, it's a separate item. The executor is entitled to whatever fee the law allows him to take, whether or not they pay an attorney, whether they do anything. So,
Thank you, Mike. Like I said, Mike's the chief. Is my big boss. So, okay, so if you have further non-resident questions, you can just call. You could look on here to see our tax questions that non-resident inheritance tax facts that we have online. You can contact our hotline, or Mary has given permission for her number, but please don't bombard her. But she's wonderful. She knows everything about non-resident tax. That's her email if you have questions for her. And she knows everything. She's fantastic. And she's the nicest person on the planet on top of that. The following are just various returns that we have. Our inheritance tax return, we call it an ITR. The non-resident return, ITNR. State tax return, IT estate. These are other forms that we have. Okay. Thank you so much for joining us.
Thank you so much, Lisa. There are no further questions as of right now.
I'm sliding in solely. Uh, Hello, everyone. Just want to thank you so much again for joining. If you have any follow-up questions, that information was placed in the chat. Lisa is absolutely amazing. We love her here at Taxation University. So again, thank you so much for joining. We got a few questions in terms of the recording and the presentation. So solely just for a second, I just wanted to address those two questions. I didn't want to keep placing them in the chat. This is valuable and great information. As our supervisor, Bill, said in the beginning, this is the information we all need to know at some point. In terms of the presentation, we all know that tax law is ever changing, right? So for the presentation, the best thing to do is actually I've placed a link in our website. I've been posting quite a few links as in terms of resources. That is the best place to go, as that as our website stay more up to date. If you have the presentation today, something could change tomorrow. So please access the website. In terms of the recording for today, we will be reevaluating the recording, checking it for quality and clarity, and then we will place that on the same exact website you use to register for today's seminar. Okay, so look out for the recording there. And I believe that is pretty much all I see in terms of that solely. So again, if you have any further questions, you can reach out to Lisa at the contact information she provided. She's absolutely amazing and knowledgeable. Again, we would like to thank all of you, and stay tuned on our website. We have more seminars coming to you guys that are free seminars that we are offering. So we would love to have you, and we would appreciate any feedback you have. So if you have any feedback, you can email taxation.university@treg.nj.gov. And if you forget anything I say, it's okay, because our email is available on our website as well. All right. So thank you so much. Have a great day. Enjoy the weekend. The weather's been nice. Have a great one, everyone. Goodbye.